Welcome to episode 67 of the Real Estate Syndicator Live, and I am super excited today to have my good buddy Chad Sutton on the show today. Chad, how you doing, my friend?
Hey, happy to be here. Long time coming. Good to see you, my friend.
I am so excited. I actually, you and I have been working together for a little while here.
Couple years now.
I did not realize that you have a fascinating background. Like, we're always talking about business, but you have a ridiculously fascinating background as a former, I'm going to just say, a NASA rocket scientist, although as they call it in my neck of the woods, an aeronautical combustion engineer. Like that's like probably one of the most unique backgrounds I've ever heard, from going from a sort of your corporate job to being a syndicator. So ton of stuff I want to talk about today. I know you're involved in acquisitions, so I want to talk about your thoughts on where the market is, underwriting, acquisitions, all that good stuff. But why don't you tell everybody a little bit about yourself, specifically this angle of the NASA engineering, because I think that's fascinating, and let us know how that helps you on the in the real estate syndication world.
Yeah, absolutely. So, I guess how much time do we have? So I'll try to be succinct. I feel like I've lived like 4 lifetimes by the time I'm 35, which is pretty neat. But look, I was that kid who grew up playing with erector sets and all sorts of stuff like that, and Legos, and was good with numbers. And so the world told me, Chad, you're going to go be an engineer. That's what you're going to do. And so I focused on that. And it was a rewarding path. I wound up graduating with an engineering degree. I wound up, hold on, our camera's doing something really weird right here. Let's turn that off. It's not you, it's me. It's not you, it's me. Okay, there we go.
Great. Everybody can see great.
Yeah. And so, wound up graduating with an engineering degree, getting a master's in that. And I went to work for NASA back when the space shuttle was still flying. So I dated myself just a little bit right there. I'm not as young and beautiful as I look, but but yeah, so I had the fortunate experience to work on the space shuttle main engine, which, if you remember a picture of the space shuttle, it was one of the 3 engines on the back of the airplane looking thing.
Not the one that blew up though, right?
Not that one. That was before I was even. I was not in practice.
Not to joke about that, but I just.
Yeah. I will tell you though, when I was an intern for them, that was like they didn't have a lot. They weren't that good at providing work for interns, and so my boss came in and laid a stack of papers that thick on my desk one time, and I was like, "What is that?" And he goes, "That's the Challenger report. I want you to read it cover to cover and summarize it for me." So I was like, "Oh, wow." Okay. So, and it was a lesson. He wanted me to know like what happens when you make a mistake,
Right.
So, people.
And today you just put it in a chat GPT and get the summary.
Yeah, it'll design a rocket for you. Exactly. It's pretty wild. But, look, I went and worked for NASA for a couple of years, focused on designing sustaining the space shuttle main engine and doing a lot of propulsion testings. It was really cool. I would work for like 6 months for a test that lasts like 1.5 seconds and capture all this high-speed videos. It was kind of nerdy, and kind of neat. But look, I got really good at things that have smoke and fire and go boom. And I got to work on what is now the SpaceX rocket for a while. Before SpaceX bought the rights to that technology, it actually was a NASA design that was meant to replace, to be another moon rocket program. So I got to do that for a while. It was super cool. But as you'll remember, back in like the 2000 and I don't know, when was this, 2008, 9, 10 timeframe, the economy was struggling a little bit, to say the least. And the government decided, look, we're not going to play in space while we don't have an economy, And so I went to private practice after that. I went to work for another little company of called GE,
Right.
And I spent many years, honestly, the bulk of my career with them, but that switched me from spacecraft to aviation. And so I spent a lot of time designing, the military rocket or military propulsion engines. If you fly on a typical commercial airliner, the engines on that I worked on. So I was the combustion guy. I designed a lot of those new engines. If you're flying on it or on a plane right now, I probably touched your engine. So I hope that gives you solace. I don't know. But anyway, so I had a really great career in engineering, Mauricio. But what happened is I did several design programs, and every time I got increasing responsibility and I started to have headcount and all that. And what I noticed is every single time I seemed to have less money to do the job, less time to do the job, and the job was getting harder. And so I was working harder and harder and harder the further I got up the corporate ladder. And I'll tell you what, it started to end it for me was I have a couple of patents. If you search my name under combustion, patents, you'll find 3 or 4 patents that I have in aerospace combustion technology. Wow. And those patents put us into I'm just going to say a pretty good, like a lot more zeros than I have behind my name, market segment. And I got a few $1,000 and a attaboy smack on the rear end for that. And I was like, okay, well, this proves to me that, Earl Nightingale says it the best. your rewards in life are commensurate with the degree of difficulty to what you do and how hard it is to replace you, period, the end. And no matter how good of an engineer I was, no matter how creative I was, there was 50 other guys behind me ready to take my job who could do it with the resources GE had. And so that's kind of where I started to despecialize.
Sounds like you're in that rat race, that classic rat race that Robert Kiyosaki talks about, right?
That's exactly what it is. And look, the problem is I was so specialized that I could only work for one of three companies in the world, really, and maybe some contractors, but I already worked for one of them, and so I didn't really want to keep with that trend. I started to despecialize, and it was around that time, where the story takes a turn. And you remember when GE's stock price went from like $40 down to $4 in like
I
6
remember
months?
that.
A lot of dividend investors were not happy about that.
Yeah.
I was fortunate.
08, or something, right? Was that 08, 09?
No, it was way beyond that.
Yeah. Oh, beyond that.
This was probably, I don't know, 2013, 2014.
Okay. So after
like that.
Okay.
So after the 09 crash, this is when GE started to get in trouble.
Got it.
And so, they came looking in our company for people who knew how to design and manufacture hardware, who knew how to manage people, and who had a little bit of financial savvy. And then the fourth piece was who could like talk to people and like instill culture change, which is kind of a hard thing to have. It's like a quadfecta in an engineer, And so we're not usually known for being super outgoing and talkative and things of that.
You're an exception, man. You're like me. You're the anti-engineer. I'm the anti-lawyer. You're the anti-engineer.
Yeah. And so my job for the next couple of years became, okay, here's a big Amex with corporate card. Go fly around the world to every single facility we have, like globally. I mean, I was in China, Norway, anywhere, Scandinavia, Eastern Europe. I was all over the world. And my whole job was, how do we make these super complex industrial products that GE makes? So at this point, I wasn't aviation anymore. I was all of GE. And it was, how do we make them more efficiently, but still have the same efficacy in the market? And so I was literally like, how do I make things cheaper, and save the company money and manufacture better? And so imagine having to walk into a factory in Norway as an American, young 20 something, and go tell them that the way they've been doing things for 40 years needs to change. It was quite the challenge to learn how to instill change, how to, make process changes and actually go find the money. And that's where the corporate journey kind of ended, because I did very well there. Yeah. That led to a global commodity leader role, which was kind of a pseudo executive role where I was responsible for a huge amount of purchasing spend in the wind turbine business for GE. Right. And, that's where I ultimately exited corporate, and we can pause it there, Mauricio.
Yeah, I was going to say, as you're talking about this, now I know why you're so good at the syndication world with processes and systems, because it sounds like that was kind of, you basically learned that stuff in corporate America.
Oh yeah, from one of the best companies to learn from. And I'm going to give you those lessons that from each one of those points here in a second, because the last thing I did was my job was negotiating an international spend with international suppliers and taking everything away from them as big GE and knocking all the margin down. And man, I was good at it. But the problem is, for me to win, they had to lose, and I was good at it. So ethically it sucked, but monetarily it was good. Yeah. And so, the lessons that came out of that, and I'll maybe pause there, is like, look, I'm an engineer, so numbers come naturally to me. I can financially model or physically model anything you want to talk about, right? Including multifamily. And you'll hear me talk about the physics of multifamily a lot. Like, there are physical attributes you have to model to make sure it performs right. Then I get into the whole cost consciousness, where it was like, how do I value engineer something? How do I make it do the same thing with less money, right? Enter pro forma management. And then the final thing is, imagine how much negotiation and legal work and contract work and all that is in real estate. Well, gosh, that was my life as a corporate executive with GE. So it became this, it was almost like this perfect path I was supposed to be on to then enter into this world with world-class training from an amazing company.
Yeah. And I definitely want to talk. I know the negotiating stuff. I know personally how good you are at that. And I know it's kind of your humble brag. And I want to talk about that in a little bit, about how you use that, especially when it comes to stuff like best and final, because I'm super fascinated with this whole concept of best final. But let's switch over to the syndication part. So you obviously at some point got into the syndication world. Now you're working with Quatro Capital and some amazing folks there. And you guys have been crushing it now ever since I've met you. You've been
about 5 years under the name Quatro.
Yeah, under the name Quatro. So you got a pretty good pulse on the market, especially how it is today. And since you're in charge of acquisitions, you want to kind of update us on that? Like, where do you see the multifamily market today, literally as we're talking, Q3 of 2023? Are you guys buying? Are you guys monitoring? What are you guys seeing out there?
Yeah, that's a good question. And, as the acquisitions guy, your role evolves. As you have projects that season, you also become the dispositions guy, the capital markets guy, the refi guy, and the deal structure guy. So
Right.
really anything related to structuring deals, selling deals, buying deals, refinancing deals, I'm the deal guy, right? And so where is the market today? Gosh, it's very different than it was 12 months ago. And I'm kind of thankful for it because, I was honestly more nervous consummating acquisitions in 2018 or 2019, 2020, 2021, when I knew things were priced very high, right? There was a lot of money in the market. You were having to get a little aggressive on assumptions, but not too much to try to pull things off and bet on the market a little bit. And for the most part, that's worked out pretty well. But, the market has retracted itself, not because the fundamentals are in trouble. Like we still, if you just go macroeconomics, we have a basic supply and demand issue. We're something like 7 million homes or 7 million rental units shy of where we need. And we're closing fast. We've been building a lot, but then we're another 3 million single family homes off, and we have not built enough of those. Both of those make the rental market fundamentals very, very solid. Look, as inflation really started to take off, we've been talking about that for 2 years. So I'm not going to get into why that happened. We can if you want, but inflation happened. And, because we printed a bunch of money and then we had to, quantitatively tighten or pull money out of the market and increase interest rates at a rapid rate. Well, look, there's some problems there, not because, the consumer is somewhat hurt, but the consumer is still pretty strong. Think about the fact that, there's like 60 or 65% of the US that owns a home. About 40% of them are on 3 or less percent interest mortgages, right? They're not hurting, they're okay. That's like an extra 15 grand a year in purchasing power. Now the other challenge is in the lower end demographic where it's more paycheck to paycheck and doesn't own a home, that has become a challenge because just basic cost of living has increased, gas, groceries, like the basic stuff you do. Like, so those who are already living paycheck to paycheck are starting to get behind on rents, run up credit cards, things of that sort. So what I would tell you is, when you're looking at the rental real estate market, I would be very cautious to be, holding the bag on some, lower end resident bases. And I still own some C-class. I haven't sold it all off, but there is some pain there where not everyone can afford the rent anymore. Now you look at the more healthy resident base, the A and B class guys, it's business as usual. Like usually their salaries are still keeping up. They're not really buying homes right now because it just doesn't make sense for most of them. So for the most part, they're staying put. And so that sector of the market is really healthy. But I think where we're going to start to see pain, and we already are, if you look at the office sector, is there are loans that are maturing, whether it was a long-term loan or a short-term loan. We're not in a buyers or sellers market, folks. We're in a lender's market. Okay. The lenders have all the freaking control right now. And it's maddening. But the problem is if you have a long-term loan coming due, unless you have a ton of equity, you're probably doing a cash-in refinance or selling when you don't want to. If you have a bridge loan coming due, and I'm not immune to this, I've had to refinance a few. Fortunately, we've been able to get them all done. But if you have a bridge loan coming due, you probably thought conservatively interest rates would be 4.5% or 5% back when you originated. Well, they're 6.5 to 7, and so and oh, by the way, expense loads are up because taxes and insurance and marketing and all sorts of stuff costs, payroll. It all costs 15 to 20% more than it used to. So you've gotten a hit there. So there's just a lot of pressure right now if you're an active owner or becoming a seller, where you really don't want to be having to transact right now. And so if you have plenty of time on, like the majority of our portfolio that has long-term loans on it and things of that sort, it's business as usual. The rental market is still strong. The fundamentals are still strong. Maybe household creation has come back, or formation has come back a little bit. So maybe my occupancies across the nation they're down 1% to 2%, but you're still mid 90s,
Yeah.
So for the most part, you're in good shape. I think the opportunity is going to be, if it shows up, what happens with loans coming due. For the most part, what I've seen so far is lenders have remembered 2008. Their balance sheets are already in trouble. They do not want back an asset where they have a loan for more than the asset is worth today. Okay. And so if you're feeling some of that trouble, know that you as the borrower, you have more power than you think you do. They're going to threaten you and send you nasty letters and do all this kind of stuff until you talk about giving the keys back. And that's going to be where they say, oh, whoa, let's talk about extending this loan. We don't want this back, and that's not all cases, but most cases. So I think in summary, the market is strong from a rental perspective. Capital is tough. The capital markets are in turmoil. Short-term debt is virtually gone right now. And you can't afford it. You might as well raise 100% of money from your investors if you're syndicating, because it's a better rate. And look, about the only game out there that I'll even entertain right now is 5-year agency financing. You can get full-term IO on their full-term interest only, that is. But you're probably going to be at about 65% loan to value and 135 debt coverage. So as long as you can stomach that, just do the loan. And you don't want to lock into that high rate for 10 years, because you'll really be kicking yourself in year 8 when your prepayment penalty is $4 million.
Yeah.
But, other than that, like, just the only way you get in trouble, folks, and I'll leave you with this. The only way you get in trouble is you run out of time or you run out of money. And honestly, it comes down to time, because if you run out of money, you run out of time. So just find ways to give yourself time to survive until 2025. Hold good assets. Don't buy something you wouldn't want to own for 30 years, right? Warren Buffettism, and you'll be okay.
I've heard that a lot, the survive to 25. So that was going to be one of my questions. So it sounds like you're pretty comfortable going out 5 years. So if you're going to buy something and you're doing sort of the traditional 5 to 7 year pro forma, or you're comfortable with that because you think that's 5 to 7 years from now we're going to be back where we were before, or where do you see us in 5 to 7 years? Because that's usually the usual timeline, right?
Yeah, well, look, I mean, we were, let's not kid ourselves. We've been at Disneyland, the happiest place on earth for interest rates for the last several years. I don't think we're going to see those again. I'd love it if we do, because I'll definitely put some stuff in place. But honestly, I think if the Fed has some choices to make, and there's two things that kind of drive this, right? One is look at our currency. We have what's called fiat currency, as does every major country in the world, right? The dollar is not a tangible fixed thing. It fluctuates in value. And, you can print more of it. Like we just saw, we printed however many trillions of M2 money supply, like 40% of the overall money supply. Well, here's the challenge. In currency world, no fiat currency in the history of mankind, look this up, has ever outlasted or has ever survived 97% devaluation from what it was originally valued at. We are at like 95 and counting. Okay. So it's like, if we get to a situation like the dollar's towards the end of its life, and what do governments do? They'll rebrand it, or another currency will take over. You're hearing all this news about, BRICS and all these nations coming together trying to de-dollarize the world. I don't think that's going to happen. We can get into that if you want. But simply put, we're probably, and you're hearing talks about the digital dollar. That's a rebranding tactic. That's all that is. They would reset it, And so, like, the problem is, I say all this to say, if we start to decrease rates dramatically and we get back to 3%, y'all put me on record 3-4 years from now, we're going to be having the same conversation, because inflation will blow up again. They're going to have to cut it again, and it'll be the same issue. And then we're going to get in the cycle where the currency will explode. So I think best case scenario, I'm pretty comfortable with 5-year debt right now, because it's the best of both of good and evil, right? If you sell an asset, you're going to wind up paying a prepayment penalty. And here's the way those work. If you have a prepayment penalty, if the rate when you sell is higher than the rate when you buy, your prepayment penalty will be lower. I.e., hey, I lent you at lower money, I can get more money out of it today. Yeah, go ahead and get out of that loan, because I want to make a new loan. If it's the other way, if you take a loan at high interest rate and rates are down here when you sell, they're going to be like, I don't want that money back. And if you do, I'm going to charge you an arm and a leg for it, right? That's how that works. It's variable. And so, like, if you go 10 years, you're really going to be stuck for 10 years. And maybe that's what you want. If you go 5 years, you can get a full-term interest-only period. It's an assumable loan. You can pull a supplemental on it. So if you go do your value-add plan, you can either sell it to the next guy, and it's somewhat attractive because there's interest-only on the whole thing. Nobody likes assuming an amortizing loan. Or you can pull a supplemental or secondary financing on it and kind of do a cash out refi. So it's the best of both worlds. And I think you really have to give yourself 5 years right now, because you have no idea what the next 2 to 3, 4 years are going to be in what we're in right now. And look, and I guess the last comment is, where are we going to be in 3, 4, 5 years? We're not going to be at the same interest rate. I think we're going to level out at probably 5.5, which is a very good interest rate, by the way. I remember people who were ecstatic to do a 5.25 interest rate loan like 5 years ago. So it's not that old.
Right.
I think we're going to have some isolated pain. There's already been a pretty massive foreclosure where someone got in trouble and lost 3,300 units. A very sad thing for those investors. But I think what you're going to have to do is you're going to have to focus on keeping your cash balances high, be able to service your debt. Maybe don't renovate everything you've got unless it makes sense and you're still getting the premiums, and just ride this puppy out, because values are going to recover. They're not down that much on multifamily. I think it's like maybe average of 15-17% across the asset class. And look, as soon as money comes back into the market, as soon as rates even pause, we saw this earlier this year when rates paused, things started to normalize and level out, and then they started hiking again and it stopped. But as soon as we see the end of the cycle, we know where the top was, and we start leveling or coming down, you're going to start to see money come off the sidelines, people trying to scoop up distressed sales. They won't be as distressed as you think because of what we said on the lending side of people being more apt to extend than force a sale. And we'll get back to some form of new normal.
You mentioned that you recommend, as I think it's prudent, to keep some good cash balances there for either emergencies or just being able to service your debt. What do you, at this point in time, what are you guys holding in reserves? Is it still sort of 6 months, or are you guys going a little bit further out?
Yeah, I can't put a standard number on it, but what I'll tell you is if you're underwriting something new, I'd recommend 6 months to a year, at least, like 6 months for a nice, well-operated property, probably a year to a little bit more for a older, maybe more unpredictable property. What you don't want to be right now is undercapitalized, because I'm here to tell you is ugly out there if you're trying to get gap equity or rescue capital or something like that, where it's something behind your senior lender, and they're not going to be very happy about it either. So don't be undercapitalized. Just accept the fact that if you don't have someone going through your due diligence with you, like a construction team, and doing these quotes, and even if you do, you better just accept like a 25 to 30% margin on top, especially on top of an old building. You might be able to go down to 15 to 20 on your CapEx plan on margin for like a 2000 or newer build, because there's really not that much infrastructure that'll be wrong. But things just cost more today than you think they do. And I'll give you an example. I am about to do a parking lot where I have to, it's a bad one, but where we have to grind it out and start over. But I'm about to do a parking lot where, this level of work would have cost me probably 40 or 50 grand in the last 3 years. It's going to cost me $100,000 to get it done. Mm-hmm. Right. And so some of the bigger ticket items, you really need to quote them out, because you just don't know where the cost of materials have driven this, or the supply and demand on labor. And for general unit work, I'm not really seeing a good renovation for less than $12,000, honestly.
And that's a good, and how do you underwrite stuff like that? Because that, in terms of the unknown, right? Like what is it going to be 2 years from now? All these construction costs, especially if you're doing a value add, how do you actually go about underwriting? Before you answer that, if you guys are I know you guys are in the chat there. If you guys have got a question for Chad, just drop it in the comment for us. I know Clearview Eastern Fund is in there, but drop a comment or a question. Much rather have you guys ask the questions than me, even though I've got a laundry list of questions. But and if you're getting some value from this, please hit the like button there. But so how do you underwrite in today's, how, with all these unknowns, right? I mean, obviously you don't have a crystal ball, but so are you changing anything in your underwriting from what you're doing today than you were doing 2 or 3 years ago based on everything that's going on?
Well, I can tell you for darn sure we're not doing a standard 3% income increase, 2% expense increase. Because the problem, and I'll tell you guys, if you break apart every pro forma I have, I am meeting or exceeding in 95% of situations income. Income is great. That's the part you have to remember. The supply and demand for rental housing drives income. It does not drive NOI. The expense load, income minus expenses, drives NOI. And so the challenge that I'm seeing for the first time in my career in this business is expenses are rising in some cases faster than income. And that's a scary thing, because, for example, if you're an operator in the state of Texas, I don't care if it's Houston, Dallas, San Antonio, wherever, we experienced a major reinsurer blow up in the market. Strata literally almost went bankrupt after the freeze last year and exited the market. Well, that left a void. And so whereas property insurance, we already saw it going up, and it was probably, $300 to $400 a door. It sounded like $900 to $1,500+ a door, right? And so you want to talk about absorbing that. If you had a pro forma, 3 or 4 years ago that was assuming 300 grand a door, growing 2% a year or something like that, and you're now paying $2,000 a door, $1,500 a door, $1,000 a door, you can't underwrite that, right? And so I'm taking a different approach to risk mitigation, and you should too. Okay. The contrarian view is you just put everything into the numbers and you bake margin in. Well, you can try to underwrite that way, but it's going to be hard. What I venture to say is, I'm looking at markets and submarkets from a risk mitigation perspective. I will literally go like not only the usual stuff we do, like job growth and wage growth and rent growth and crime and all that normal stuff you would look at. I'm looking at how litigious is the state. I'm looking at, I have maps now and if you want to see this map, go check out my buddy, with Shine Insurance, Jeremy. Oh my God, I'm blanking on my friend's last name. It must be stage fright. Anyway, but go check out Shine Insurance. And my buddy Jeremy will tell you, he has a map that kind of shows like by color where the roughest spots are for insurance. I've ranked all 50 states by propensity for insurance risk. I've ranked all 50 states by payroll growth, for like our payroll. I've ranked all 50 states by, things like utilities, so it's like you have to think about where are we getting hit the hardest on expense growth and maybe avoid that until it stabilizes, because you just can't know. You cannot underwrite it, right? And so like, for example, I'll drop some props to my market in Evansville, Indiana, right? Pretty steady from a property damage perspective, pretty steady utilities, so I can kind of better predict my expenses. And so, I still do a 2% increase over what I underwrite, but I underwrite a lot more conservatively on like, okay, if I'm getting quoted, $500 a door in insurance, can I withstand 7? Right. And I try to bake in more margin on the front end, so that we have that room. And on the CapEx side, which is a little more brief, it's really going to come down to how long it's going to take you to do the work. If you're doing it all in a year, you can maybe carry less margin. If you're doing it over 3 years, you probably want to carry more like 30% margin on it. And look, fund, like people don't put this in their line items enough. Fund working capital, fund reserve capital, fund, just like an OSNAP fund, right? Like just think about the fact
like a contingency line, a contingency line.
More, and not just a small one, like a healthy one. You need more money than you think you do. And I'll tell you what, if you're a syndicator, the number one kiss of death is a capital call. Okay. And so I would much rather overraise by 20% and show lower returns, finish the project and be able to give back $1 million or something like that later than to say, shoot, I was too aggressive and I need another $1 million now.
Right. Yep. And underwriting is obviously tough. I'm going to ask you my favorite question I've been asking everyone is really how do you even figure out your exit cap, which is going to be my next question. But before I ask you the exit cap question, I really I'm making a conscious effort not to get too deep into the macro with you, because I love doing macro. We could probably do a whole episode on macro.
Yeah.
But one of the things that you do talk about a lot, which is macro, which I think is very related to what we're talking about now, and also related probably to exit cap, is this idea of the long-term debt cycle that Ray Dalio has been talking about a lot. I know you follow that a lot. Give us the sort of the brief, I know that's kind of tough to do, but give us like a brief long-term debt cycle issue that you're seeing or that Ray Dalio is seeing, and then how that's going to be affecting, multifamily, as that debt cycle issue progresses.
Yeah. I guess the first thing I'll say is folks, if you're not following Ray Dalio, you should be. Bridgewater Associates, major hedge fund, kind of a big deal. He puts out really good videos that you can actually understand how money works in the economic machine. And he has a great one called How the Economic Machine Works on YouTube. It's 30 minutes, best 30 minutes you'll spend. Watch it 2 or 3 times. But it'll give you a real basic understanding of what I'm about to talk about, because you need to go watch. Like, you're going to see my finger going around and you're not going to see the graph. But, the point is, we know we have elastic currency, right? And so the way that that money works is, the U.S. Treasury issues, the U.S. Treasury issues bonds. Those go to banks. That turns into money. Banks can lend that same dollar out 10 times. And so anytime you see the Treasury create money, all that works out into the economy and becomes. But the crazy thing is, it's not about like having too much money in the world or not enough money in the world or too much debt or whatever. Like, here's what I'll tell you that'll blow your mind, and you won't get this until you watch the video. But if we paid off all of our national debt, the whole economy would collapse. Like, we cannot do it. Everyone's debt is someone else's income, period. So it's like, think about it this way. You're a car manufacturer, right? You may not be able to sell cars unless someone goes and gets a loan and buys that car, right? Or, for example, somewhere along the line, your employer probably has some loans to provide working capital or stimulate their business, and some of that's paying your salary, which in turn goes and lets you buy groceries and all sorts of other stuff. So every dollar in circulation, every dollar lent is someone else's income. And so it's a very interesting concept. But when you think about it, there's what's called the big debt cycle and micro debt cycles. And so I'm going to try to draw this. We're only on YouTube, right? Everyone can see me here.
Yes, everybody can see you.
So if I draw a line here where I'm going up and down like a sine wave, like an up and down wave, there's a little debt cycle that's going all along what I just traced, up and down, right? And we're so zoomed in. We're like up here on that little bitty line I just showed. You can't see. Like, you in your life cannot say, oh yeah, there went the big debt cycle. I remember that from 1974. It doesn't work that way, right?
And by the way, these are similar to even real estate markets. Like, if you think of a real estate market, you see it going up and down, but in the trend is typically in real estate, it's up. With the long-term debt cycle, it's up to a point, and then it kind of comes down, and then kind of keeps going back and up and down.
But unlike oil and gas, it doesn't, like, there's not a flat line and it's going up and down on that. It's going up and down and increasing, up and to the right. And the difference there is productivity. We get a little bit better with every cycle. That we do more with less and all that kind of stuff. So our productivity gets better. I mean, think about it. When we were mining gold back in the 1800s, we're a lot more efficient at that now than we used to be, right? So we can mine a lot more gold with the same money. So point of the matter is, it takes about 50 to 75 years, which is ironically a human lifetime. It takes about 50 to 75 years for us to experience a full debt cycle. Okay. And that is where, you have lending increasing, and then eventually you get to the top where it's kind of too expensive, which we may be feeling now, and people don't want it anymore. And so borrowing stops, and then maybe the market crashes and you have a big drop. And that's what's called a big deleveraging event, right? And the Fed has been talking about a soft landing. They're talking about what would be called a beautiful deleverage, which is where, like, things can gently slide down, reset, and keep going, not a train wreck where they crash and blow up and all that kind of stuff, right? And the crazy thing is the debt cycle, the recession we saw in 2008, that was a micro debt cycle. It was a big blip, but it was a micro blip on the big blip. And so the crazy thing is, and this is where I think we should have a little bit of, not fear, but pause. We should recognize is we may be in a time where that big debt cycle is happening. And when you think about it, the last time we had inflationary events and interest rate movements like we have was about, 1970s, right? Where are we? We're in 2023. It's about 50 years. So I think we are feeling a big debt cycle right now. What I'm not sure of yet is whether or not that's going to be a beautiful deleverage where we're going to achieve that soft landing, maybe bounce on our rear ends a few times and then keep playing, or whether this whole thing is about to melt down and it's back up, batten down the hatches for a few years.
And how does it influence your thesis? Does it influence it, or are you just keeping a really close eye on it? Because depending on which direction it goes, you may switch your thesis, or does it play into your everyday analysis of the real estate market?
No, I mean, I think the thing I love about real estate is, like, look, if we've talked about big debt cycles, we've talked about inflation, interest rates, we've talked about the currency maybe blowing up. All those things are like huge events, right? But what I know about real estate is even if the currency falls apart and we're like buying food in carrots and paying rent in carrots, right? I'm still going to be able to rent a room at this place for a number of carrots. I don't know how many carrots that is. Maybe it's like 1,800 carrots, whatever. It's a lot. I'll be like Bugs Bunny over here. But the point is, real estate is a tangible, hard asset. That's why we love it. Regardless of what the money is doing, if inflation's taken off and the dollar's devaluing, well, guess what? My property's worth a lot more money. It's the property holds its value and grows. And so I'm still very bullish on acquiring hard assets that fulfill a basic human need: food, water, shelter, right? Shelter is what I've chosen to invest in because everyone needs it. It's not going away. You can't ever just say, well, the economy's bad, I guess I'm not going to live somewhere, unless you want mass homelessness. So Is it affecting my thesis? Yes, it is, but only on the debt side, on the capital stack, right? As I mentioned before, the property fundamentals are solid. Inflation has driven expense problems. You have to underwrite that and make sure you're buying right for the long term. I don't buy anything I wouldn't want to own for 30 years, right? That's a Warren Buffettism.
Right.
And really, I'm just a little more careful what debt I use. And for me, that means raising more equity. I haven't put a loan on a deal that was more than 60% in quite some time. I've given preference to fixed rate debt, or I have heavily capped my variable interest rates. For example, a year ago, I did a bridge loan and I bought a 1% rate cap, which means like the index was only at 0.5 at that time. I had a 300 spread. So all in, my rate was 3.5%. Well, if I didn't buy a rate cap and SOFR went from 0.5 to 5.5, I'm now paying 8.5. Yep. That's a big problem. I was buying 1% strikes before it was cool. People said I was crazy, but it's turned out to be a pretty good choice.
Yeah. By the way, lovely Rita Pita is asking here about, website or the link to the Shine. I actually found it, and your buddy's last name was Goodrich. Jeremy Goodrich.
Jeremy, I love you. I'm sorry, dude. I know Jeremy very well, but I think stage fright, I couldn't spell out his last name.
That's all right.
Look for Jeremy Goodrich on LinkedIn. Actually, it's Goodrich. Cool. And that chart I tell you about will be there, but it is shineinsurance.com. They're a great group. I've got a lot of stuff with them.
Cool. Clearview Eastern Funded. What do you think about loan assumptions and recapitalizing loans rather than buying with new debt?
I love it. So, and I think I was on record saying like 3 or 4 years ago, like, wow, all these loans being done right now at 3% and all that kind of stuff. It's going to be a huge assumption market a few years down the road, because I was under no illusion that we'd stay at 3% forever, or 2.5 or 4 or whatever it was. And so I'm selling a deal right now. One's closing tomorrow, but the other part of that portfolio is a loan assumption. And it was very attractive to them to assume my loan assumption that was when I bought it, it was like 80% loan to value. Now it's 60%. But in today's market, you can't get 60% on a new asset because the rates are so high. And so like if he got new debt, he would have been at like 50%. With my debt, he's getting 60. And so I think assuming loans is great as long as you have enough term on them. I would not do it if it was like within 5 years left. But if someone has a good 10 or 12 year loan and they're a few years into it, assume it. I think it's a great idea. And you mentioned, I think the second part of that question was recapitalizing loans. In my mind, so I'm also doing that. I have one loan that is coming due on a portfolio, and the other two have a great Freddie Mac 12-year loan. And so what am I doing? Well, that one loan, I can only refinance it so far to a certain point. And so I decided, well, I'll just pull a supplemental on that good Freddie Mac loan that's so cheap. And the supplemental is expensive, but all in, it takes my 3.3% rate to like 3.9 or 4.1 or something like that. So I think if you have good long-term debt where you can do an assumption or a supplemental on an acquisition, you should really prioritize that, because what I'll tell you is debt funds and banks are not what they seem right now. They are fragile and they're scared of their own shadow. And so you might think if you're acquiring, you have a partner in that, and they may cut you at the last minute, or they may walk away from the deal entirely with no explanation and say, sorry about you, whereas the agencies, they definitely are executing, and they're pretty much a sure thing. As long as it fits into the box, the underwriting box, they'll do it.
Yeah, that's such a great point. It's one of our big risks that we disclose a lot in our docs, is that point. It might even be on the equity side too, because we've got private equity groups that'll come in and say, hey, we'll commit X amount of money, but they may back out at the very last minute. You might be 2 weeks out to close or a month out of close, and they'll say, you know what, we're getting cold feet and we're not going to do it. And now suddenly, crap, your money's gone hard. You've got to close in 3 or 4 weeks, and you really are in a tough position. So yeah. So let's get to I want to get to my exit cap question, because I ask almost every guest, and people tell me, oh, it's an art, a science. I mean, I couldn't even start to tell you how you go about figuring out what the exit cap's going to be in 5 or 7 years or whatever, or maybe 2 to 3 years when you're trying to refinance. Give me your process of how you go through an exit cap analysis when you're underwriting your properties.
Yeah, this isn't hard, by the way. People say it's an art and a science. No, it's not. So it's very simple, right? And folks, if you're a passive investor, this is the number one number you need to be going to look at, because I can make a really bad pro forma look really great by increasing or decreasing the exit cap rate by 1%, and depending how low on the scale you are, that 1% is worth a whole lot more. Okay. So here's what I do. The first thing I do is I say, stop thinking about the cap rate. because the only way you get in trouble in real estate is you run out of time, you run out of money, right? And so you'll project, maybe you're a syndicator and you want to project a 5-year hold, right? That's fine. But we always tell people on our webinars, like, look, we're projecting 5 years because nobody wants to pretend to be married for 10 years. But look, if the market's not good, I'm not going to sell it until the market's good. I'm not just going to sell it just because we're at year 5. And so we have this agreement. And I also say, look, if market's great, I might sell in year 3. We'll figure it out.
Right.
But the reason I say that is you need to be underwriting these properties to make sure they produce positive, like they are a productive asset. They generate positive cash flow. If you're going to take on negative cash flow, make sure you know what you're doing, but make sure you have a plan that you will, without fail, will get it to positive cash flow. And if that's the case, you can outlast anything. Okay. And, especially with not putting shorter than 5-year debt on it right now, you've got 5 years. If you're positive cash flowing, you've got at least 5 years before you have to worry about it. And then you can talk about extensions if you had to. So now let's talk about the cap rate. Okay. Because if you're cash flowing, then the cap rate's less important, but, I do a spread. Okay. And because investors have their own risk tolerance. Some are like, well, why aren't you taking advantage of the market getting better? I think Houston, Texas is going to be great. This is probably going to compress. Some say, nope, I don't look at anything unless it's purchase cap rate plus 100 bips. Fine. I look at 3 points all the time. I look at, and I usually do it across 3 basis points on cap rate. I look at what my purchase is plus 1, purchase rate, purchase equal to sale, and purchase minus 1. So if I'm buying at a 5 cap, I'm going to look at a 4 cap on the good side and a 6 cap on the high side, and that helps me understand, okay, what's my general propensity? But then the disclaimer is I have no freaking idea what the cap rate's going to be. I have no idea, no control whatsoever. I can't tell you what the interest rate's going to be. I can't tell you who wants to buy multifamily. All I can tell you is this is a cash flowing asset. And we believe the market's strong in this area for these reasons. We read these tea leaves. And so we feel pretty good about maybe this cap rate. But if it goes south, here's where it would be. And I always have in my head, I don't show this, I just have it in my head for a question. Like, what does the cap rate have to be where we don't make any money? Like where we chose to sell it. We just, for whatever reason, we decided we're done and we sold it and we broke even, right? What is that number? And, I like to see that number at least north of 6.5 or 7, because if we're so. Yeah.
And I forgot how, because I know not a lot, but some people do sort of the whole sensitivity analysis. They show almost a whole grid. Some people just show
it's too much,
2 or 3. Do you show any of that sensitivity, or just, hey, this is what my prediction is? You do the strike price 1 point up, 1 point down. Is that what you're showing?
I do show it. Yeah. I used to show 5 points. Like I would do like a quarter point increment, but now I just show like flat cap plus and cap minus 1%. And, and I kind of highlight the flat because that way people will focus on like, okay, if nothing changes, if all we do, and the reason I tell this story is not to say the cap rate's not going to change, but if all we do is what we say we're going to do, what we are in control of, which is the value add plan. If we do that and the market stays the same, here's how much money we make, right? Market gets a little bit worse. Here's how much. Market gets a little bit better. Here's how much, right? But you cannot predict the cap rate. So don't even try. And I would encourage you not to shoot yourself in the foot and show your investors a worse cap rate than when you buy it and say, I'm conservative and this is great. Like, you should show them the potential of the investment, but then you talk about how it can go the other way,
Yeah. No, I love it. Love it. Guys, if you got a question for chat here, for the few remaining minutes, drop it in the comment, please. I do want to ask about your best and final strategies. Your humble brag is you are a master negotiator, which I've seen you in action, so I know that's true. But walk us through best and final. I mean, it's probably gotten, well, maybe I'll ask you whether it's gotten better or not, but obviously back in the heyday, it was crazy of how many people were bidding for properties, and you end up with a few people. But what's your approach to best and final as a negotiator, as a master negotiator? What are some of the strategies you can share with us?
Yeah, best and final, it really at its core is a dog and pony show. I'm going to tell you that way. So brokers out there, I love you, but it is, right? And if I had, one property with 20 offers and one seller, I'd probably be doing it too. So it's kind of annoying because what you typically will experience is you'll work really hard to hit pricing guidance. This is back in the day. We'll talk about what I do now because it's different. We're in a different market, but when we're in a seller's market, you do everything you can do to try to get comfortable and be aggressive on a project and get yourself comfortable with the upside and what you can do to tweak expenses. And you just try to hit around the number. And so the first thing I do is I'm like, guys, like, I'm a credible buyer. I know you want to close. what does it take to get a deal done here realistically, right? And what they'll usually say to that is, well, the seller has this expectation, and I think this will get you into best and final, and then we'll kind of see where it goes. And so I usually make sure I get enough to get into best and final. I don't want to go all out and pour the gasoline out right here, because you got a couple more rounds to go with Mike Tyson here. So what you're going to do is you're going to try to extract the littlest, the information that lets you know, what do I have to do, terms and price, to just get in, just to be considered with the big boys, right? And what I'll tell you is there's a great book out there. I love promoting books, so forgive me for that. But Never Split the Difference: Negotiating Like a Life Depended on. I know you've read it, Chris Voss.
Yeah, Chris Voss.
I have a lot of tools out in that have made me a lot of money in my prior careers, and this one. And the thing I'll mention here is, brokers will literally hang themselves with information if you let them talk. Okay. And it is the hardest thing to do. But if you can ask a calibrated what or how question, that is an open-ended question. Like, how can I make sure we get into best and final? What is it going to take to get a deal done here? Right. See how those are open-ended questions, and then shut your mouth and listen. Okay. Because if you just be quiet, and sometimes it's hard, just like when they finish talking, absorb it and just stay quiet. And they'll keep talking. Like people who are brokers are great at talking, and they'll keep talking and they'll divulge something. And so what you're looking for is, what is in every negotiation, you have your known knowns, your known unknowns, and your unknown unknowns. And it's those unknown unknowns that will win you the negotiation. And so what you have to figure out is, what is the reason they're selling? What might you be able to find out that will give you a leg up? Do they have some little hot button or something that if you broach will put you in the lead or make you stand out? You're looking for that. Another trick on this active listening thing is, you have to respect the silence, but there's something called mirroring, right? If you just, like, if they say something and you want them to say more, just take the last 2 or 3 words that they said and add an upward inflection. So if I said, well, it's probably going to take, 17, 18 million to get a deal done here, and I might say 17 or 18 million, and then be quiet, and they'll start to elaborate. It works like a charm. You don't believe me? Do it with your spouse, and it'll be kind of funny to see what happens. But don't tell them you're doing it. They don't like being played with. So that gets you in the door. Okay. And so, when I'm underwriting at this level, I'm trying to make sure I have enough margin in the tank, and making sure that if I really run after this thing, I can really accomplish the goal. And so then you're going to get into best and final, and they're going to make you fill out a questionnaire, and they're going to ask you all the times you might have dropped a deal, or why, or how you underwrote, and they're going to try to vet you as a buyer, and that's great. So fill it out, and then submit your next offer. And I always have a call with them again. I say, look, all right, well, here's all the stuff we have. If you have property in the area, it's even better. It's like, look, I already own these 4 assets in the area. I'd love to absorb this. Capital's a sure thing. What's it take to do this, right? And then they're going to give you the next range. And it's like, well, they're not supposed to tell you this, but you're a friend. The deals came in here, and they're trying to befriend you, right? And they usually are not BS in the range, but they might say it's here and here, And so you find out then, well, is this the final round, or are we going another round? And so you try to be about as aggressive as you can. But if you know there's going to be another round, leave some juice in the tank, because sometimes they have bestest and finalist round, right? Which is yet another round where it really comes down to it. And there's probably going to be seller interviews. So make sure you get on the seller interviews, be confident, be convicted, like show no holes in your ability to close. None. The answer to the question, is the capital ready available, is always yes. You never push it the other way,
Right.
Just
that's probably an easy way to lose the deal, when you say, I still got to raise it or something.
Yeah. I still got to raise that 20 million bucks. Well, you'll lose the deal right there. Right. So just always push confidence. It's okay to tell a white lie as long as you can come through with it, but just, you're building confidence. And then from there, when you're on the phone with the seller, listen to the seller, like try to get them to go first and hear, what they need out of you and what's important to them. And when they feel like they're being heard, they're going to start to know, like, and trust you. And then once that trust barrier comes down, that's where you really start to become the guy. Cause I'm going to tell you, I'm a buyer and a seller. I don't pick sellers based on the best numbers. I pick sellers who can close, and I pick sellers who I like to work with, because A, no one likes a jerk. B, no one likes to waste 3 months on a transaction only to have to bring it back to market as a tainted deal, and C, look, you'd like to work with people who are easy to work with. So just don't be a pain in the neck. You know what I'm saying?
Good stuff. Yeah. You know what I'm saying?
There you go. You did it.
Hey, we've got a few more minutes, and I know you're busy too, and I know it's late where you are, so we'll wrap it up. But I do want to ask you one, because obviously you're not only an operator, but obviously you're raising capital. So tell us where you're seeing the capital environment. I mean, I would say it's harder to raise capital today. Would you agree with that? And what are you guys doing differently now? Is it taking you longer? Like, give us an update of where you see things on the capital raising side.
Yeah, I'd say in general, your propensity to raise capital now versus where it was 18 months ago is about 50%. And the reason is not because, and you could take that one of two ways. You could say I can raise half the money in the amount of time it takes to do a deal, or you can say it takes you twice as long to raise the money you used to be able to raise in the deal time,
Right.
But simply put, we prioritize investors who are individuals, not corporations. So we look at accredited investors, qualified purchasers, qualified clients. So that's everything from 1 to 10 million, right? And look, they watch the news, and especially the guys who are large in net worth, they're not going to be so quick to put it out unless they're truly convicted that it's a good investment. It's more about preservation of capital and growth rather than taking risk. And so I think the smaller investors who are probably a little less, not in the know, but a little less sure of or aware of the risks of investing are still flowing pretty decently. The larger check writers are harder to come by right now and take a little more coaxing, just because it's, they have to be comfortable, and there's a lot of discomfort right now. And so and that's the crazy thing, is like, the deal may be great. The sponsorship team may be great. They may just not be super motivated to place right now. And so it really does work against you when there's negative press out there, because while you and I know that press is just for clickbait and ratings and all that, not everyone does. Some people take for gospel what's on Fox News. So,
yeah, no, 100%, 100%. Well, that's good. The good insights there. And Chad, I've been on your podcast, the Real Estate Runway podcast. You want to talk a little bit about that? I know you've been doing it for a while now, right? How long have you been having your podcast?
Yeah, I think we started in 2021 or something like that. So it's been a while, but check us out. The link's on the screen here, thequatroway.com/podcast. Don't put the space in there, by the way. And it's
no space right there.
Yeah, it's a URL. And Real Estate Runway, it's a podcast where we just talk about all things real estate, all things alternative investing. So I'll talk about the infinite banking strategy, trusts. I'll talk about retail real estate, syndication law. Mauricio and Bethany both have been on the podcast, spitting some good gold there. Look, it's a car ride show. We don't do long episodes. We like to just, on your car ride to the store, give you some good nuggets. And it's pretty open interview format. So, love to have you guys on. If you are interested in being a guest, you can apply at the same link, or if you want to go, click subscribe for wherever you like to absorb podcasts, YouTube, TikTok, we're on all the things. So, awesome. But it's a cool show, and love to see you there.
Yeah. And speaking of subscribe, if you haven't subscribed to this channel, would really appreciate it. Subscribe. Where can people find you, Chad? What's the best way to get a hold of you?
The best way is chadsutton.info, chadsutton.info. That's CHADSUTTON.info. That will have access. That actually will have a link to the podcast. It'll have a link to any of our offerings if you want to check those out. Our website, about me, all that kind of stuff. So happy to connect with you. I love talking about this stuff, and if there's any way Quatro can help you, especially, and folks, I'll offer this up. If you are an active operator out there and you're feeling some pain right now with some lending decisions you might have made, give me a call. I probably have a solution for you, or at least some ideas to try. Because what I'll tell you is I think Ed Milet says it best: the power of one more. The power of one more phone call, one more lender discussion, one more try. You never know what's going to turn it over. And I'll tell you, I've found some solutions that I didn't know existed and the market didn't know existed that I might be able to share with you. So,
wow, that's such a generous offer. We'll definitely put that in the show notes below in the description, how to get that. Chad, I know you're super busy. I know you're home with your family, so I really, really appreciate your contribution to the real estate syndicator community. Thank you, my friend, and everybody else. We will see you next Wednesday, same time, same channel. Thanks, everyone.
All right, bye for now.
Thanks, Chad.